Well, there's been a lot of talk lately about what the smart money is supposedly doing around this shaky Middle East ceasefire. And in this video, we're going to separate signal from noise, and you're going to walk away a whole lot calmer, a whole lot sharper, and a lot more confident about what matters in this market right now. And by the way, it is Friday, April 10th in New York, so let me know in the comments what day and date you're watching from. And look, right after that, do me one quick favor. Subscribe, and if you feel like this channel brings you real value, drop John AG Best in the comments. That helps more than you think. Because if you've been hearing this story floating around that the big institutions have some secret two-path plan, one path for peace and one path for chaos, yeah, there's something to that. But there's also a lot of drama getting layered on top of it, and when drama gets mixed with markets, people stop thinking clearly, so let's slow it down. The basic idea is simple. If this ceasefire actually holds together, even loosely, even imperfectly, then you can make a pretty reasonable case that the market starts leaning back toward risk. Not blind euphoria, not everything straight up, but enough stability for money to move back into the areas that got hit the hardest when traders started pricing in worst-case headlines. And if the ceasefire falls apart, if the region slides right back into a bigger energy shock, then the whole map changes. And when the map changes, you do not want to be standing in the wrong place because you were still trading yesterday's story. Now, one thing I want to say before we go any further, and this matters. A lot of people hear that a major bank has a playbook for rich clients, and they instantly jump to, see, retail has no chance. I don't buy that all the way. Institutions do have better access, faster notes, better analysts, better distribution, sure. But institutions are also late, crowded, emotional, political, and very often trapped by their own positioning. So this is not a story about them being all-knowing. It's a story about them preparing for two very obvious branches in the road before everybody else admits there are two branches. That's different, and the market, by the way, is already showing pieces of both paths. We just saw stocks bounce as diplomacy headlines improved. We also saw oil stop collapsing and start acting nervous again the moment people realized a ceasefire headline and an actual stable region are not the same thing. That matters. Because from recent market updates, the broad indexes clawed back ground on fresh peace talk optimism, while crude stayed jumpy and traders kept one eye on supply routes and one eye on the next missile headline. So what is the bullish version of this story? The bullish version is not just war bad, peace good, buy everything. That's way too childish. The better version is this. If the temperature in the region comes down even a little, money can rotate back into parts of the market where expectations got too low, positioning got too defensive, and earnings may now have room to surprise people who spent weeks hiding under the desk. That is where this gets interesting, because according to the latest publicly available reporting, traders have been unusually cautious about growth, unusually jumpy about geopolitical spillover, and strangely hesitant to trust a rebound even after a major relief move. Retail, especially, has not been charging into this bounce the way it often does. In fact, one of the more important fresh signals this week is that individual investors were more likely to sell into strength than chase it. That is not what a fully confident market looks like. And when you see a rally that people don't fully trust, that rally can keep going longer than most expect. Why? Because under-owned markets have fuel. That doesn't mean guaranteed upside. It means the runway is there if the news flow cooperates. Now let's talk about the area everybody cares about first, and that is tech. Because yes, if this thing holds together, tech is still the first place a lot of managers are going to look. Not because tech is magical, not because every chart is perfect, not because artificial intelligence suddenly fixed the world, but because when fear eases, money usually goes back toward liquidity, quality, scale, earnings power, and companies that can still grow even if the macro backdrop stays a little messy. That is the bull case, in plain English. And there's fresh context behind that too. We're heading into a period where large cap earnings are back in focus, and there are already signs the market may have gotten a little too gloomy about some of the biggest names. One recent report pointed to stronger than feared profit growth expectations for the broader index, and especially for the mega-cap technology complex. Another showed that one of the largest cloud players is now talking about an artificial intelligence revenue run rate above the mid-teens in billions, while still leaning aggressively into investment. That does not prove the trade works tomorrow morning, but it does tell you the spending wave around AI has not disappeared just because people got nervous. And this is where I want to push back on a lazy, bearish argument. A lot of people keep saying, well, if AI spending is huge, that must be bad. No, not automatically. Excessive spending can be bad if the returns never show up. But heavy spending can also be bullish when the company's spending have giant balance sheets, high-margin legacy businesses, and a chance to own the next computing stack. Those are not the same thing. So you can't reduce the whole sector to one scare line about capital expenditure and call it analysis. That's not analysis, that's a mood. Now, does that mean every high beta growth name rips? No. That would be too easy. Now, there's another reason tech stays at the center of this conversation, and it's not just because people love the story. It's because the biggest names are still the easiest place for giant pools of capital to hide while pretending they're being aggressive. Think about it. If a fund manager has spent weeks cutting exposure and suddenly decides the world is not ending this afternoon, where can that manager put size to work fast? Usually not some tiny speculative thing. Usually the deep liquid names everybody on the committee already understands. That's why the same companies keep showing up whenever the market tries to reboot. But this is how capital behaves. First it goes where it feels safest while still giving upside. Then, if the move proves itself, it broadens. That is often the sequence. So if you're wondering why small caps don't always lead instantly even when they look cheaper, that's why. People talk about bargains. Funds talk about liquidity. Those are not always the same conversation. Still, I do think smaller companies matter more here than people realize. Why? Because if the ceasefire holds long enough for oil to cool and rate panic to stop getting worse, the market starts asking a very different question. Not what survives, but what has the most room to recover. And that's where small caps can get interesting. They've lagged enough, they're more domestic, they're more sensitive to financing conditions, and they can move hard when fear comes out of the system. Not every name, obviously. A lot of smaller companies deserve to be ignored. But as a bucket, they become one of the more obvious catch-up trades in a stabilizing backdrop. Because the market doesn't need perfect conditions to rally. It just needs conditions to get less bad than people feared. That's a phrase worth remembering. Less bad. A lot of major rallies are built on that exact sentence. You can also see this in consumer-facing groups. Home builders, retailers, discretionary names more broadly, they don't need paradise. They just need lower panic, slightly better visibility, and less pressure from energy. That doesn't solve every economic problem, but it changes the emotional tone. And consumer stocks trade on emotional tone more than people like to admit. Now, do I think people are underestimating how fast the market can rotate if this de-escalation sticks? Yes, I do. But I also think people are underestimating how quickly that hope can reverse if the region throws out one more truly bad supply headline. That's why the energy piece is not optional. It is the hinge. If crude settles down, relief can travel. If crude starts climbing again because physical flows remain impaired, relief gets capped. It's that simple. And the reason I keep coming back to physical flows is because futures can lie to you for a day or two. They can react to emotion, positioning, short covering, headlines, and machine-driven nonsense. Physical markets are usually less dramatic and more honest. When physical premiums stay elevated, the market is telling you the underlying problem may still be there, even if the screen looks calmer for an afternoon. That's a huge clue. And there's another clue tied to that. The broader economy is not entering this period from some perfect, bulletproof place. Fresh market reporting this week pointed to slower growth data and sticky inflation concerns still hanging over the tape, even as stocks manage to bounce on diplomacy. So this is not a world where investors have endless room to shrug off another oil shock. That cushion is not what it used to be, which means the stakes are higher than they look. Now let me make this even more practical. What would make me believe the bullish path is gaining control? First, I'd want to see technology keep attracting buyers even on days when the headlines are quiet. Not just one euphoric gap up after a ceasefire mention. I'm talking about follow-through, real follow-through, the kind where buyers are still there when there is no dramatic headline to hold their hand. Second, I'd want to see market leadership widen. If it's only a couple of giant names dragging the averages higher, that's fine for a trade, but it's weaker as a message. If small caps, discretionary names, selected financials, and maybe even some industrial cyclicals start joining in, that tells you confidence is spreading. Third, I'd want to see oil behave. Not crash necessarily, just behave. Stop acting like it's one bad hour away from repricing the entire inflation outlook. And fourth, I'd want to see earnings guidance avoid a confidence hit. Because strong backward-looking numbers are nice, but if executives sound nervous about demand, margins, input costs, or global uncertainty, the market can forgive less than people think. That's the bullish checklist. Now, what would tell me the bearish path is taking over? Simple. Energy infrastructure headlines getting worse, shipping restrictions staying in place or broadening, physical crude stress refusing to calm, airline and transport stocks rolling over again, defensive and scarcity-linked sectors outperforming even on days when the major indexes look stable. That combination would tell you the market is not buying the peace story, even if some commentators are. Now, there's a psychological trap right in the middle of this whole story that I think is worth naming. People want the market to confirm their worldview. If they're naturally optimistic, they want peace, tech, growth, and a big squeeze higher. If they're naturally pessimistic, they want collapse, oil, defense, and vindication. But the market doesn't care about your personality. It only cares about flows, incentives, and what gets repriced next. So if you catch yourself rooting for a scenario instead of reading it, that's your warning sign. You're getting attached. Don't do that. There is no prize for emotional loyalty to a thesis. The only prize is being positioned on the right side of reality as it develops. So if you're thinking, okay, but what do I actually do with all this? The answer is not to copy someone else's watch list word for word. The answer is to build your own decision tree. If peace stabilizes, I focus here. If energy stress worsens, I shift there. If earnings rescue sentiment, I lean into growth. If inflation panic comes back through crude, I get more defensive and more selective. You want a map, not a prediction. A map is useful. Now, as for the current tape, I think the market is still trying to decide whether this was a relief event or merely a pause inside a broader energy problem. You can see that uncertainty in the mixed action. Stocks can rally on talks. Oil can still stay elevated. Retail can still hesitate. Europe can wobble. Energy can stop being the obvious loser. That kind of split behavior is exactly what you'd expect when the market has not reached a verdict. So don't force a verdict too early. Let the market show you. And if it starts showing you that growth can hold gains while energy stress fades, the upside path becomes more credible. If it starts showing you that every relief move gets sold the second crude firms up or another supply route gets mentioned, then the stress path becomes the one to respect. Either way, the point is the same. There is a framework here. There is a logic here. And once you see it, these swings stop feeling random. Not easy, not comfortable. But not random. That's a massive advantage all by itself. But it does mean that if tension cools and earnings don't disappoint, the biggest technology names are probably still where a lot of performance-chasing money goes first. They're liquid, familiar, institutionally loved when momentum returns, and easy for funds to size up quickly. And then there's the second layer, positioning. This is the part most people ignore because it sounds dry, but dry things move markets all the time. If professional money has spent weeks de-risking, trimming exposure, reducing leverage, or just sitting on its hands waiting for clarity, then peace or even partial peace can force a decision. Not because anyone suddenly becomes brave, but because underinvested managers hate watching a market lift without them. That's when the scramble starts. Not always all at once. Not always in a straight line. But enough to matter. And this is why I keep saying the real driver here is not simply headlines. It's positioning meeting headlines. That's the combination. A decent headline hitting a market that is already all in is not that exciting. A decent headline hitting a market that is cautious, skeptical, and undercommitted can move a lot harder. And yes, retail matters too. Maybe not in the way people on social media pretend, but it matters. Retail flow has looked more defensive lately. And that's important because when smaller investors stop buying every little dip, it tells you confidence has been shaken. But the flip side is also true. Once they start trusting the move again, even a little, they can add real momentum back into the most obvious rebound areas, especially index products and the crowded growth names everybody already knows. So the bullish map starts to look like this: large cap tech, then selective growth more broadly, then small caps if people decide the all clear is real enough and rates stop looking like an immediate problem. Then consumer-sensitive names, because when oil stops acting like a tax on everyone's mood, people start talking themselves back into spending. And yes, financials can fit here too, though this is where I'd be more careful than the loudest bulls. Banks can absolutely bounce if macro fear fades, credit doesn't crack, and earnings show resilience. We've got major bank reports about to hit, and some fresh coverage points to lower valuations going into those numbers even as expectations have not completely fallen apart. That opens the door to upside if management teams sound steady. But banks are not a clean piece trade in the same way tech can be. That's important, because if rates stay sticky, credit costs rise, or investment banking chatter cools, financials can underperform even in a relief rally. So yes, they belong on the list. No, they are not the purest expression of it. Same thing with home builders and retailers. They make sense in the fear comes down, consumers breathe easier scenario, but you don't buy them just because a map says risk on. You buy them if the consumer still has enough life, if energy doesn't spike back up, and if the rally starts broadening beyond a handful of mega cap names. And metals? This is where nuance matters. Some people want one clean rule for gold and silver. They want peace equals down, war equals up. End of story. Markets are not that obedient. Precious metals can benefit from a softer dollar and lower stress. They can also get tangled up in real yield moves, liquidity needs, and broader risk behavior. So I would not treat them like a one-switch trade. In a stable relief setup, miners can catch a bid, especially if the dollar cools and inflation fear doesn't vanish. But that is not the first domino. It's somewhere after the bigger rotation into growth and risk appetite. Now here's the thing. The bullish story only works if the market believes the ceasefire is real enough to matter. Not perfect, not permanent, just durable enough. And right now, I'm not sure the market fully believes that. That is why we have to talk about the other path. Because the bearish version is not some weird fringe scenario anymore. It's sitting right there on the table. If the ceasefire unravels, if infrastructure keeps getting hit, if supply routes stay squeezed, if shipping stays restricted, if the region starts looking less like a tense pause and more like the opening act to a wider energy problem, then a very different leadership group takes over. And from recently published numbers, this risk is not theoretical. Saudi officials said attacks this week cut production capacity and also hit throughput on a crucial east-west pipeline. At the same time, reporting on the physical crude market showed something incredibly important. Futures could wobble around on ceasefire headlines, but real barrels stayed tight, with premiums for non-Middle East crude blowing out because buyers still wanted security of supply. That is the kind of detail people miss when they stare only at the screen price and think the problem is solved. So let's be blunt. If the energy story gets worse, you do not want to be cute. You do not want to be sitting there talking about a nice little broad market melt-up while crude is climbing, shipping is strained, and traders are repricing inflation all over again. That is when energy starts taking the lead. Producers, service names, midstream, storage, transport, maybe refiners depending on how the squeeze shows up. Not every name, not blindly, but the whole complex gets a second look because scarcity always gets attention. And I'd actually add one more fresh wrinkle here that wasn't getting enough attention earlier: fertilizers. Not because it sounds exciting, it doesn't, but because the same regional stress that can hit energy can also hit feedstocks, freight, and agricultural inputs. One recent piece highlighted how a large share of the global fertilizer trade moves through that region, and how nitrogen products were already under pressure before the latest conflict shocks. So if this escalates, the knock-on effects do not stop at the gas pump. They move right into farming economics and food chains. That's why fertilizer names show up in the stress scenario. Not randomly. Logically. Defense is the other obvious bucket. And again, this isn't about cheering for it. It's about recognizing what money does when governments start talking bigger procurement, replenishment, missile defense, and industrial capacity. Fresh reporting this month showed a proposed defense budget around $1.5 trillion, along with heavy focus on ships, munitions, and missile systems. That doesn't mean every defense stock is instantly cheap. It does mean the political backdrop for the group can get much stronger if conflict drags on or widens. And then you get the losers. Airlines are the easy one people mention, and for good reason. Fuel-sensitive businesses hate this kind of backdrop. We already have fresh evidence of higher jet fuel pressure feeding straight into airline behavior, with carriers lifting fees and adjusting schedules as costs swing around. That is before you even get to the confidence hit on travel, if headlines deteriorate. So yes, in the escalation path, airlines can get hurt quickly. Broad equities more generally can wobble too, especially the high multiple areas, because higher oil complicates rates, complicates inflation, complicates margins, and revives all the ugly macro questions traders were desperate to stop talking about. Now, I also want to challenge one more assumption here because I think people sometimes get too neat with this. The assumption is that if conflict gets worse, the dollar automatically surges, stocks fall, and that's the whole story. Maybe, but not always in a smooth, textbook way. If energy stress hits hard enough, you can also get weird cross-currents where certain inflation hedges rise, certain equities tied to scarcity rise, and the broad tape still feels terrible. In other words, bad macro doesn't mean every line on the screen goes red together. That's why sector rotation matters more than headline emotion. And that, honestly, is the biggest lesson in all of this. There is almost always somewhere for money to go. People hear market down and think everything dead. That's not how this works. Money doesn't usually vanish evenly. It relocates. It seeks safety, yield, scarcity, growth, defense, liquidity, pricing power, whatever the moment rewards. The real skill is not predicting every headline. It's recognizing where the flows are likely to run when the narrative shifts. That's the game. And if you've never looked at the market that way, this whole conversation can start changing how you think about bad news. Because bad news for one sector can be a tailwind for another. Relief for one basket can be a headwind for another. That's also why I'm skeptical whenever someone says retail investors are hopelessly behind. Are they disadvantaged? Sure, but they're not helpless. The edge does not come only from having a note a few hours earlier. The edge comes from understanding the structure behind the note. Once you understand the if this, then that logic, you stop depending on somebody else to spoon-feed you a ticker list. And by the way, if you're successful, share your success story in the comments so others can stay motivated. Now let's pull this together. If the ceasefire more or less holds, the cleaner expressions are probably the ones you'd expect. Big tech, selective growth, some small cap participation, a rebound in risk appetite, possibly consumer-sensitive groups, maybe a bounce in financials, and then second-order beneficiaries if the dollar softens and inflation fear cools. The fresh market action actually lines up with parts of that already. Consumer discretionary has shown strength on better sentiment. Volatility has eased from conflict highs, and some of the market's favorite growth names are getting another look as investors revisit earnings and AI demand. If the ceasefire breaks down, the map hardens in the other direction. Energy first, then adjacent commodity exposure, then defense, then fertilizers, while transport-sensitive and fuel-sensitive groups look vulnerable, and the broad market has to reprice the inflation hit. And the fresh Saudi production and pipeline disruption reports tell you this is not just a made-up spreadsheet exercise. Real infrastructure has already been touched. So where does that leave us right now? Honestly, in the middle. And I'm okay saying that. Because too many people think confidence means pretending to know exactly which branch the market takes next. It doesn't. Real confidence is being prepared for both branches and knowing what would confirm one over the other. That's why the next few sessions matter so much. Do we keep seeing buyers step back into growth even when oil firms up a little? Do earnings from major companies sound resilient enough to pull people back into risk? Do small caps join the move, or do they lag and tell you fear is still underneath the surface? Do crude and physical supply indicators calm down, or do they keep whispering that the energy story is not finished? That's the checklist. Not hype, not panic, a checklist. And one more thing here, because this is easy to miss. A lot of the fastest moves happen when everyone is staring at the wrong variable. Right now, a lot of people are staring only at the ceasefire headline itself. But the real tells may be second order: retail participation, hedge fund re-risking, physical oil pricing, shipping conditions, guidance from big companies, and whether leadership broadens beyond a handful of giant names. Those are the things that can tell you whether the relief is real or whether the market is just taking one deep breath before the next shove lower. So don't get hypnotized by one headline. Watch behavior. Watch flows. Watch who's buying. Watch what stops falling. Watch what refuses to bounce. That's where the truth starts showing up. And yes, I know some people wanted this to be a cleaner story, maybe even a dramatic one. A giant bank whispers the answer. Rich clients get rich, regular people get left behind, end of movie. But that's too simple. The real story is more useful than that. Big money is preparing for a split-screen market. That's the takeaway. One screen says relief, growth, tech, earnings, rotation back into risk. The other says energy stress, supply disruption, defense, fertilizer, airline pain, inflation pressure. Neither screen is guaranteed. Both are tradable. That is the point. And the reason this matters so much right now is because we are at exactly the kind of moment where investors lose discipline. After sharp swings, people become desperate for certainty. They want one sentence, one direction, one magic answer. But markets usually punish that craving. They reward flexibility. They reward people who can say, if this continues, I lean here. If it breaks, I pivot there. That's a grown-up way to think about risk. And frankly, it's how professionals think when they're being honest. So no, the takeaway here is not that you should worship institutions. And no, it is not that you should ignore them either. The takeaway is that there is value in understanding how the biggest desks frame a problem, then stripping out the noise, the theatrics, and the false certainty. Once you do that, the picture gets cleaner. Not easy, cleaner. And that's enough. Because if peace holds, the market probably has room to squeeze higher in the very areas people were most afraid to own. If peace fails, the winners will likely be uglier, more defensive, and tied to scarcity and state spending. In both cases, somebody wins. In both cases, somebody gets caught staring at the wrong chart. Don't be that person. Stay flexible. Stay honest about what the tape is saying. And stay allergic to anybody promising certainty in a market like this. This whole discussion is for education, to help you think more clearly about risk and opportunity. It's not a personal recommendation, not a trading order, and definitely not a substitute for doing your own homework before you put real money on the line.